What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is April 14th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I want to spend some time to finally talk about why now we are finally starting to prepare to go short in the market. I want to spend some time to talk about why we've been hesitant to ride a lot of the wave up we've seen here in Bitcoin's price over the past few months. And on top of that, talk about why we're more eager now than ever to finally start making bets to the downside. We've been sitting in cash, remaining patient for the most part. So I want to go ahead and talk about why now we're finally starting to get convinced that it's time to start betting to the downside. We've got a lot of things to dive into in today's video from both Bitcoin and crypto markets, as well as the macro scene. So if you guys enjoy the rambling, consider dropping a like. It's one of the best ways you can support the channel. And let's go ahead and kick off the rambling. All right. Now, I understand this is always a point of contestment. People are always going to see things different, guys. People have different approaches to trading markets. And I want to make something abundantly clear here. A lot of people have been asking, Nick, why haven't you been trading up? And on top of that, as you've been sitting in cash, why are you going to be going short now? I want to go ahead and explain the reasoning for this here. And the reasoning is not because I hate Bitcoin. It's not because I don't believe in the potential promise of crypto as an asset class. None of that has to do with the case. And to the question of why I didn't ride the wave up during this relief rally is because of a very important principle. I like to trade with the broader trend. And when I say this, I mean that when we are in a secular bull market, right, when Bitcoin is continuously having consistent bear market corrections, we know that the Fed is constantly injecting new liquidity. That's the narrative. That's what drives prices higher, increased credit in the economy, and disposable income is going to lead towards speculative assets going up over time. I'm riding the wave to the upside, and vice versa. When I know that we're in a contractionary period, I'm generally going to be betting against assets, and I'm only going to be doing it when I see overt exuberance. Because when I know that there's overt exuberance in the market, like there is now, as we've gone up from around $15,500 towards around $30,000, a near 100% move in Bitcoin, this is where I start to sink in my teeth. This is where I want to build short positions to bet to the downside. And I understand some of the critics or people who have disagreed with us here. I respect anyone for their viewpoints, but what I don't respect is people claiming that we've been short. We have not been shorting the market. We have not been building short positions over the past few months, which is why being in cash is a great neutral position. You don't have to chase every opportunity. You want to wait till the setups come your way. And boy, do we have one now, finally. As we enter into the previous support pocket back during the last cycle, this has a very high chance of serving as resistance, especially after a 100% move in Bitcoin's price. This is the kind of relief rally stuff that I'm looking to short. And there's a big reason for this. Now, a lot of people generally look at previous bull markets, and they're thinking that this is a repeat of 2019. I'm going to go ahead and let you all know that it's likely that we are not repeating the kind of same hyperbolic fast recovery that we had in the last cycle. At least we're not going to be going to that extent, a 300% move, roughly speaking, right? From bottom to top, this was a massive expansion in Bitcoin's price, a much bigger move that carried out for a longer period of time. So far, we've seen about a 100% move. So I really don't like when people make this comparison. What I really think is a lot more fair when it comes to percentage terms and is more relevant to what we are experiencing right now is the same relief rally trap that is constantly played out during this bear market. A lot of people make the case that this was the all-time high in the cycle, and it's true. In November 2021, we did set in a slightly higher price. But notice here the pattern that we may be very well repeating. A 139% move from the midterm or mid-cycle correction lows that were back here in June of 2021. And within a matter of about 20 weeks, we saw Bitcoin rally 139%, only to fall back down right at a time when everyone was convinced of the super cycle, of the dollar collapsing, and Bitcoin being the super asset that's going to go towards $100,000. Well, what happened after? We entered into a brutal bear market, a multi-month downtrend, almost going down for an entire year, actually pretty much an entire year from our peak in November of 2021. This cycle has been defined by these exacerbated moves since back in 2019, and it speaks to a broader issue in crypto. The broader issue is overt speculation through derivatives. Liquidity has flown into derivatives and futures contracts, and that has left the spot order book incredibly susceptible to whales who can take advantage of it because they have the mass, they have the liquidity, and they can extremely exacerbate their profits and swing the market in favorable directions to their positions, allowing them, whether it be the exchanges, whether it be whales, to take advantage of traders in the spot or derivatives markets. Doesn't matter which market you're looking at. The idea is to make exacerbated moves, squeezing out shorts during these relief rallies, and basically liquidating or at least hitting the stops on a lot of longs on the way back down. It's the simple nature of the game, folks. And if you can't understand that, if you don't understand who is really directing price here during these quiet times where there's not really any narratives, there's not some massive QE injection, there's not stimulus checks being handed out to everyone like there were during the pandemic, then you're going to get chopped up. You're going to get caught up in the emotions. And this is the perfect time now to go against those emotions, to go against the FOMO here. As we mentioned, we've been patiently sitting on the sidelines, but we've been listening to these indicators. And I'm going to start running through why we're so confident in this, guys. All right, first off, let's go ahead and talk about Ethereum here. Ethereum finally deviating to its highest level here since back in May, knocking out any potential shorts here in this market, or at least starting to put them underwater, getting them concerned. This is where people start to close their positions, their stops start getting hit, and this is bear in mind, a long period of time of trading activity. Anyone who's built shorts in here, again, during this window of time, is now underwater, and this is what leads towards deviations. This is where essentially by people closing their positions or people being forced out of their positions, you start to have maximum liquidity for institutions to start building shorts. This is the name of the game. It's the same way here. For example, if you have price, starting to continuously test a low, and we start to see a new low formed, and after that, price accelerates. That's exactly what happened actually during the FTX collapse. We had a huge flush down below the previous lows. That's when everyone was convinced, everyone was perma-bearish, and while we were generally of the negative sentiment at that time, we weren't going short the market. We weren't recommending people to go out and 5x short Bitcoin. What we were doing at the time is remaining with the trend, right? So the key thing here is that now we are starting to clear up towards these levels that have not been seen for multiple months. That is the perfect opportunity to provide the ample liquidity on the other side of the trade for large-scale investors. And once more, I want to go ahead and focus on the longer term trend, because one of our key momentum indicators here, even though we've had a break above the line here, what's really great about it is that through its color pattern, it will let us know whether or not there's been a trend reversal. And you guys may not be able to see it here, but this is still red. It is not flipped blue. And we're going to talk later on as we look through some of the equity charts that the momentum shift is still not present, whether it be in Ethereum or whether it be in a whole range of other assets on that monthly time frame. And until we see that, we're not too convinced that this is going to be a full-on bull market. We've got to be able to sustain that trend and continue moving higher. If we can't get a blue flip on the monthly indicator here for a multitude of different assets, chances are this is a very, very tricky relief rally, and one in which is going to trap a lot of investors. It's not about what you can afford to make, it's about what you can afford to lose. Now I want to come back to this point here before we dive into those charts and talk a little bit about stablecoin liquidity. Again, I constantly keep hearing this narrative. A lot of people convinced that liquidity is just surging into the crypto space, that there is still a continued bank run going on, and people are just moving money out of banks en masse. And while it is true that people are moving money from regional banks to larger established banks or different types of money market accounts, areas where they can essentially get, a decent yield with the Fed's rates being at its height that we've seen over the last 20 years, obviously, large investors are going to start to move money if banks don't start paying them a decent interest rate. Well, what we're seeing now in the crypto space is not the same kind of euphoria or optimism. We're seeing stablecoin liquidity sitting where it was in October and November. Month over month growth was 0.07% or $74 million. And while that may sound like a lot of money, it's a fraction, as you can tell by percentage terms, from the real dollar liquidity that already exists in the crypto space. There's $112 billion of stablecoin liquidity down from the peak in May. And for those who don't think this is an important metric, take a look back at what happened in May of 2022 onward into November of 2022. Month by month by month, we had stablecoin liquidity contracting and we had Bitcoin's price following suit. We are not seeing a rapid expansion of stablecoin liquidity. And that is going to be needed. It has been needed every single time since stablecoins like Tether have become a component since back in 2015 for Bitcoin's price. If Tether is not expanding and coming under increasing scrutiny, we need to be very cautious. Not to mention, taking a look at USDT, USDC dominance, or coming down to that support line here. Last time we were here was November of 2021, and the last time after that was February of 2021. Those were the two ranges where we set in that high around 65 to 69K. Are you sure you want to be chasing the FOMO now, guys? If you've been this patient, if you've been waiting on the sidelines, this is the moment where it's finally time to start sticking to actions that match with our thesis. We've been patiently waiting for a very long period of time for this moment. And all we need to do now, we need to wait for the momentum signals on the shorter term time frames to start to show weakness, to start to give us those signs that it's time to start fading the trade. Now, I want to go ahead and talk about why, again, I'm quite confident on this position. And it's not just me bashing crypto, guys. I love cryptocurrencies as an asset class. We've been covering crypto here since 2017, much longer than a lot of the people out there who are perma bulls, who think this is absolutely going to be the next bull market and are so confident in telling you that Bitcoin's going to go to $1 million and you got to put all your net worth into it. Folks, the big thing here is that it's not a bet against Bitcoin. It's not a bet against crypto for that matter. Maybe a bit on altcoins because this is really not the environment to be long altcoins. What it is, though, is a bet against all assets. Take a look here at some of our different metrics. This is VTI. This is one of the most popular investment ETFs. It's got billions upon billions of dollars placed into it. It is a weighted ETF that allows you to have broad exposure to the stock market. And what's great about that is that it kind of serves as this index. And trust me, we'll look at the S&P 500. We're going to look at the Dow Jones, the NASDAQ, all the other indices you guys know about. But I like VTI sometimes. I always come back to it because it's a really great measure of the broader performance of the stock market. Sometimes if you're looking at the NASDAQ, you get isolated looking at the high-risk stocks. When you're looking at the Dow Jones, you're just looking at defensive. S&P 500 is going to be relatively similar to this, but I like VTI here for the purpose that it is really a basket of practically the entire stock market. And what we find here when we zoom in and just look on the kind of past couple of months, really over the past year, the stock market has continued to face resistance here, at least on VTI around 208. This has been a point where every time we got above this range, we faded by the end of the month. So we are in the month of April here, and it's looking like we're finally going to come up and retest this range. So the stock market might have another percentage or 2 points to go, and then after that, we are going to see likely a fade in price. And once more, our momentum indicator has been signaling that there is not a flip yet. We have not seen that trend reversal just yet. We have not flipped blue, signaling that the bulls are in the lead. What we do have, though, through our premium Lux Algo indicator partner here on the channel, we can see that there are some huge liquidity ranges. The accumulation ranges, as you can see, the green bar outweighs the red during these periods of time. That is how bottoms are formed. When we see real capitulation and therefore at the tail end of that capitulation, institutions with bid side support ready to drive the next bull market. As the only way you are going to see the start of another secular bull market. It happens time and time and time again. Now, the question is whether or not you think this was the bottom of the bear market here back during September. And I know a lot of people are convinced of that right now. I know a lot of people are feeling that FOMO. But I'd take you back here to our momentum indicators. And again, we had a very deceptive period of time where equities had formed a temporary bottom in January 2008 and rallied up 19%. It continued to chop sideways until September of 2008, and after that, only when something had broke, we finally saw the real capitulation. And if we are going to see something like that, how is Bitcoin going to fare during that period of time? Is Bitcoin going to go to the moon, go to 100K, new all-time highs, one of the most risk-on assets on the market? Or is it going to be facing some pain? Now, I want to make it very clear, I'm not nitpicking here trying to pick VTI. I just like to start off with this. We can go ahead and see the S&P 500 on the monthly time frame. Same exact story, has been red since March. And since then, has been continuing to face resistance roughly on a monthly time frame, each and every month around this 40 to 4,200 point range. And I think we've still got a long ways to go until we get into that accumulation range where institutions are actually going to be scooping up equities. NASDAQ as well, which has made some serious gains since October, not going to lie, is still in the chop range and is still not seeing that flip on the momentum indicator. And we can see, going back through history, right? This indicator can help provide a ton of value here on spotting long-term trend reversals. So until we get that cross, I'm not too interested. The only one here that started to kind of teeter with the blue trend flip is the Dow Jones. And guess what index out of any of them actually did that last time during the dot-com bubble? Oh, it was the Dow Jones, because people rush the defensive stocks and they think that that's going to save them because of the dividends, because of the cash flow. Unfortunately, at the end of the day, as we've talked about before, over the past couple weeks, past couple months, nothing is safe during a contractionary period. Valuations contract in an environment where there is less credit and liquidity. I don't want to speak in absolutes, guys. I don't want you guys to be convinced that I think we have all the answers here. But folks, I mean, whether you're looking at the technology stocks, the S&P 500, the Dow Jones, whether you're looking at Bitcoin or Ethereum, we are seeing repeated patterns here that unfortunately can trap and trick up a lot of investors, a lot of good-meaning people who, again, I understand at the end of the day, want to see a return to the good times of the last decade, where the Fed could always just come in, supplement quantitative easing. There'd always be some kind of narrative, and therefore the Fed can print. But guys, the Fed has a mandate here. It needs to get inflation under control. And I can promise you all, if the Fed does not do that right now, the Fed itself knows this. If it does not address inflation properly and continue suspending rates in this environment, which is going to put pressure on equities and other assets, if they don't do that, inflation is going to come raging back. We are going to see triple-digit crude oil barrel prices that are going to take oil towards prices we have yet to see in our history. And that is going to have ripple effects across these entire supply chain and the cost of goods and services we pay for. It will make inflation come raging back with 0.5, 1% month-over-month increases in the cost of living. The Fed doesn't want that, and I think we don't want that either. So we need to be realistic about what the Fed is likely going to do and how that's going to affect asset prices. I know it can't be fun all the time. I know that that sucks, but I'm here to be realistic with you guys. I'm not here to promote referral links. I'm not here telling you to just stack sats and go out there and put all your money into it. We need to be cautious. This is what is going to define the successful traders and investors versus the unsuccessful ones during a bear market. And while I don't want to be a monolith of opinion, you guys come here for my opinion and my trading strategy. And as much as we have things like the Dash Report, where we do have some things that are, again, a part of our subscription model here on the channel, we want to give you guys a ton of free content. And one of them here is that our general narrative is that things are going to start moving down. Another thing here as well, again, a lot of people say don't bet against the trend. Let's zoom out to the long-term trends, right? That's where it matters most. Take a look at the VIX here. The VIX is yet again in its support range since as far back as November of 2017. So is this really the time? Again, we understand that volatility moves inversely to stock prices in the vast majority of cases. So if the VIX is this low and it's at historic support for the last 5 years, likely means it's going to rebound. And if the VIX is rebounding, volatility spiking, that means equities are going to start to move lower. We've been remaining patient since back in March here, waiting for that VIX to contract into this range. Just where it was back in January 30th when everyone, the FANG stocks were rallying, Facebook or Meta gapped up 25%. Everyone was convinced that it was time to go long these stocks. That's my cue. When the FOMO is real, when I start getting people who are, oh man, I'm in cash, I really, really want to get into trade now, that's my cue. Because I know that's when peak FOMO is starting to form in. And it's time to take a contractionary trade. Another one of our indicators here that we're using within the Lux Algo suite again gives us these really great bands of potential resistance and support. And this one has been working really well on the dollar. I know a lot of people are focusing on de-dollarization, the narratives in the headlines. It's come out of pretty much nowhere because of some trades and liquid natural gas that were conducted in Chinese yuan. It's a fraction of global volume. De-dollarization maybe is something that will play out over time, but it will take a decade or more to play out, and it's certainly not going to be attested or challenged by the Chinese yuan, which, when you're considering demographics of China, the fact that people don't want to immigrate or store their wealth in China, the Chinese yuan, as much as I think China is a very interesting country, it's a beautiful country in many ways, there's a lot of flaws there, and it is not going to serve as some major world reserve currency. I don't think the world wants to store its wealth in a currency that's backed by its two largest components, which are Russia and China. Just being realistic with you guys, we kind of, the West has been kind of at war with Russia over the past year as a proxy war with the Ukraine. So these are the kind of points that I would really keep in mind here. When I see the dollar coming down about 14 points, last time we saw the dollar index move down 13.7 or 15.6 points. We're back here around 15.3 or 15.8 points. That's when we start to see buyers coming in. So I think as we move into that 15.5 point range, look at that. We've got our Lux Algo support band starting to signal that it's time to get long the dollar. So if we get a deviation below 100 points here on the Dixie, if anything, I'm looking to go long the dollar here. I'm not looking to go long gold, looking to go long precious metals. Why is that? Because each and every time we've come up into this range in August of 2020 or March of 2022, we've usually gotten faded on the trade. Now, if we get a significant breakout and we can hold above that range, then I'll definitely consider precious metals. I'll definitely consider that there might be some kind of trade there, maybe in the gold miners, where there's a little bit more kind of, not per se leverage, but a little bit more movement in price off of the base commodity increase in valuation. Right? Gold's been on a nice rally since October 2022, right? It's made some significant moves here in its price. But time and time again, this is the range where we don't exist very long, so to speak. We don't stay up in this range for very long. So at the end of the day, guys, look, I want to take a moment to just kind of reflect here and step back. I know a lot of you guys are upset that we didn't catch the previous bear market rally, or whatever this is. Maybe it is the start of the next bull market, as many people are convinced of. I know some of you are upset that you didn't get to catch that wave if you followed us here on the channel being in a cash position. But the one thing I want you guys to realize here is I'm not here to get you to FOMO into the market. This channel is not meant to be some kind of business where I just promote the most emotional stuff and I get you to use my referral links. There's so many content creators out there who just play with the grind of being always bullish. And to be honest, that really worked over the last decade. That's what a lot of people did, and a lot of people became prominent market gurus and investors. But I'm a macro trader at heart. And more importantly, I have some morals and standards that I have to stick to. I'm not going to be here to lie to you guys. I'm not here to get you to FUD or FOMO. It's why we didn't short the bottom. And it's also why we're not trading relief rallies to the upside all the time during what we believe is a broader downtrend. And sure, yeah, maybe we can make the trade. We missed it. Right? There will be tons of opportunities as a great trader that you are going to miss. But what every great trader has as a definitive trade, if you go towards looking towards people like Ray Dalio, if you talk to people like Stanley Druckenmiller, you will find a consistent trend. But they do not chase every single opportunity. They know what trade setups they look for. And if you can nail 2 or 3 trades a year, even just one really good trade, especially in this contractionary environment, you will outpace the vast majority of participants. And you will come out on top, and you will be ahead of the curve, and you won't be constantly emotional thinking, oh my gosh, this thing's going up, this thing's going down, why did I make the trade? You got to be well prepared, and you got to be contrarian when everyone is trading on one side of the trade. Because chances are, the more crowded that side gets, the more likely the trade is over. And it's time to start preparing for the other direction. And that's what we're doing here now, guys. We've already built some short positions across some of the kind of short-term leaders and the equity space. And when it comes to crypto, we're going to be starting to build some positions that will give us short exposure to crypto. There's some ways to do this. And if you guys are interested to figure out what kind of plays we're making and what kind of shorts we're betting on, you guys can join the Dash report at the link down below in the description. It's a great way where you guys can follow our different types of technical analysis, our setups, our different trades that we're looking to take. As I mentioned, we've already made one here, so we send out trade alerts so you guys can know at what price, in what assets, and what way we are trading these different types of assets and positions. You guys will get the Dash report, which is a 20+ page newsletter where I cover crypto markets, equities, commodities, and Forex. You'll also get our mid-month webinar, which is going to be happening later on today, where you guys can ask me questions. We can go over and dive into some of the charts. There's all kinds of stuff from the Dash report discussion group and all types of other features like exclusive market updates that you guys get in the Dash report. And what's great is if you subscribe, is 20% off on an annualized basis. Really, it's a relatively good cost, less than a cup of coffee per day. And I think that it's going to be something that for a lot of you could really help you accelerate your trading journey. But again, even if you guys can't do that, I hope you enjoyed this video. If you did, consider dropping a like. That's one of the best ways you guys can support the channel. And if you guys want that additional information, or if you guys want to get access to really solid indicators like Lux Algo, you can find it down below in the description. We've got a 30% discount code where you guys can subscribe to any package you'd like. Try it for a month if you want. Try for a quarter, a year, however you'd like. But that's it for today's video, guys. I've rambled on a good amount here. I hope if anything you guys can see that I'm not trying to be too negative. I'm just trying to be honest with you guys. And now finally, after many months of talking about it, it's time to finally put our money where our mouth is and finally start building the right positions. Thank you guys so much for continuing to support us here on the channel and allowing me to ramble. And until the next video, I'll see you all in the next one. Take care, everyone.